All right, everybody, welcome back. Continuing our discussion of the equity method of accounting. When you see equity method, what do you think again? Significant influence, do not market to market value, and dividends are not income. All righty, so that equity method, first thing we need to record is, hey, what did we pay for this? That will be our initial carrying value, the price paid. Now, your price paid is going to be the sum of the cash paid plus the debt issued. Plus, if you issue your stock for their stock, you would use the fair market value of the stock issued. So it's cash paid plus debt issued plus the fair market value of the stock issued. And any cash you pay, well, that would be a cash outflow investing, assuming this is going to be accounted for as a non-current asset. By the way, you'd also have to add in, you'll see in a second, but you know there's always a lawyer out there, right, with their hands in your pocket looking to get paid. So if a lawyer helped you and represented you in this transaction, you owe them money. That would be added to the initial carrying value of the investment account. So it's the price paid plus the freaking lawyer fee. Damn lawyers, man. Yeah, I know. I'm thinking a lawyer at the bottom of the ocean. Good start. All right. So investment account. Now, we know we don't market to market value. So how do we get the ending carrying value? Well, it's got to be adjusted during the year for our percentage share of any of that investee or affiliate's net income and any dividends. So you start with your initial carrying value, your cost, your price paid, you'll increase it for your percentage share of their income. So let's say they had income of $1 million. And let's say you own 30%. You have significant influence. $300,000 that'll increase your investment in that affiliate, and that will be net income on your income statement. You will have equity earnings from an affiliate, $300,000. So the asset goes up, net income goes up, so retained earnings and equity goes up, you're in balance. Now, if they pay a dividend, we know that's not income. So if it's a dividend, read carefully. Assuming it's a cash dividend, right? We're going to debit the cash, but then we're going to credit the investment account. We're not going to credit dividend income, and that's the key because we're so accustomed to dividends or income, right? It's not income here. It's a return of capital, as we know. But again, it's your percentage share of the dividend. So let's say they had $1 million in earnings, but let's say they paid out $200,000 of that as dividends. Well, if you own 30%, then you're going to debit cash for 30% of $200,000, 60, and then you will reduce your investment in affiliate account by $60,000. So it's your percentage share of the earnings, your percentage share of the dividends. Now, be careful. We don't always have a profit. Sometimes you invest in companies that are losers. Yeah, but my CFA, that's not worth the paper it's printed on. Unfortunately, not doing so well in the market right now. But nonetheless, you invest in a loser. While you would add your percentage share of profits, read carefully. If they had a loss, you would subtract from your carrying value your percentage share of losses. So that would reduce your investment account. And then that would also be a loss, which would reduce your retained earnings in your equity. So you'd have to actually debit the loss, right? And then you'd have to credit the investment account if there's a loss. So just read carefully. The other thing is, you can't ever have a negative carrying value for an investment. So if this company year after year after year has losses, well, little by little, your percentage share of the losses is writing down your carrying value in that investment. Once you get to zero, you got to stop. You cannot continue to record your percentage share of losses if it would give you a negative carrying value. Okay, that's your lowest carrying value. All righty, so our main journal entries, equity method of accounting. Step number one, what'd you pay for it? What's your cost? Cash paid, debt issued, fair market value of stock issued, plus the legal fee. So we'll debit the investment account, non-current assets go up, credit cash, current assets go down, and that's probably cash outflow investing. All righty. So for the investment account, assuming it's a non-current asset, cash outflow investing. Now, total assets don't change. They only change form, right? We're less liquid now. All righty. During the year, they have profit of $1 million. We own 30%. What's our percentage share of the $1 million? 30% of $1 million, 300,000. We would add that. Our percentage share of the profit, we would debit the investment account, bring up that non-current asset, and our percentage share of profit is our income, not the dividends. Our percentage share, that's our income. So then we'll credit equity earnings from the investee or the name of the company, but it's equity earnings. That would make our net income go up, which makes our retained earnings go up, which makes our equity go up. Just make sure it's only your percentage share. You can't pick up 100% of it if you don't own 100% of the company. And then what would reduce our carrying value? Dividends as well as losses. Let's just isolate the dividends. So we know it's not income. So our share of the dividend. So again, if they paid a dividend of $300,000, but let's say you only own 30%, we're not going to record dividends for 300,000, 30% of the 300,000, 90,000. Assuming it's a cash dividend, you would debit the cash. And then what would you credit? Not income. That'll be the most common wrong answer choice, equity method. That'll reduce the carrying value in the investment. We credit the investment account. So current assets go up, non-current assets go down, total assets, no change, all right? Just be careful. Not all dividends are going to be cash. It could be what? A stock dividend, right? So if it's a stock dividend, memorandum entry only. So if they give you a stock dividend, your number of shares you own goes up, basis per share goes down. But again, no journal entry if it's a stock dividend. Okay, so a little acronym. We know that the ending carrying value on the balance sheet, when equity method, we know we don't mark it to market value. It's an adjusted balance. Beginning balance plus things that make it go up, your percentage share of earnings, you add that. Then you subtract things that make it go down. Your percentage share of dividends, not income, your percentage share of losses. And there's your E in the base acronym, there's your ending value. And we do not mark it to fair market value, okay, unless it's impaired, which we'll talk about later. So here's an excellent example. January 4, year 1, big corporation acquired a 40% interest in small company for $300,000. Stop right there. We just bought 40%. So what's the presumption? We have significant influence. We'll use the equity method of accounting. Dividends are not income, right? We don't mark it to market value. Okay, so the price paid is $300,000. That's our initial carrying value. They also tell us, this doesn't seem important yet, but it will later. Well, they tell us on the day we bought them, their net assets had a book value of $750,000, and that book value also represents the fair market value, okay? So I'm just adding the book value, fair market value, one and the same right now for a simplistic example. We'll get more sophisticated later. So by the way, where did they come up with the $300,000 purchase price? Well, the book value and the fair market value for this company are $750,000. So they said, well, 40% of that, you know what, a fair price to pay? $300,000. More to come on that later. All right, during the year, this company had a profit of $90,000. That is not all yours. Remember, your percentage share, 40% of 90, that's going to make our carrying value go up, $36,000, and that'll be our equity earnings, not the dividend, but our share of the profit. That's what we include on our income statement. Okay, the company did pay a dividend of $40,000. That's not all ours. Our percentage share, 40%, $16,000. We'll subtract that. That's not income. That reduces our carrying value. So cash goes up, but the investment account goes down. So total assets, no change. Okay, it's considered a return of capital. So the journal entries, the initial investment, don't forget to add in any legal fees if they're there. Debit the investment account, credit cash. In our example, $300,000, total assets, no change. At the end of the year, this is why I have to have access to your financials if I'm going to do the equity method, because I need to know your profit. And if you're not publicly traded, I need you to share this with me. So they do share it. We're using equity method, 90,000 times 40%. Your investment account goes up by 36,000 and equity income goes up by 36,000. That makes our net income go up, which makes our retained earnings go up, which makes our equity go up. So assets up, equity up, balance sheet is in balance. They paid a dividend. Not all of that belongs to me, only 40%. That's my percentage share. So that's $16,000. It's a cash dividend, so cash goes up. By the way, under U.S. GAAP, when you receive a cash dividend, that's operating cash flow. So current assets go up, and now we're not going to credit income. That will be the most common mistake. Equity method of accounting, we credit the investment account instead. That reduces our non-current assets. So cash goes up, non-current assets go down, total assets no change, only a change in form. So folks, you got to be very familiar, and I'm going to give you a more detailed flashcard in a little while. But the investment account, we don't mark this to market value at the end of the year. They might give you that, but that'll be distractor information unless it's impaired. Assuming it's not impaired, fair market value is distractor. So we start with our beginning balance, right? Base acronym, beginning balance, our initial cost, which includes the legal fee, $300,000. We add our percentage share of a profit. We would have subtracted our percentage share of a loss, but we have a profit. So we add the 36. We subtract our percentage share of the dividend, 16. That's how we get our ending balance. It's an adjusted balance, okay? So the ending carrying value on our balance sheet, the owner's balance sheet, big company, they would show investment in small company at the end of the year of 320. They would not mark it to market value. And big company on their own income statement, they would show equity earnings from affiliate or investee of $36,000. All right. Now, sometimes in a more complex example, you might not only own common stock in that company, but in the same company, you own common stock and preferred stock. You have to separate those two investments. For the common stock, I need to know, do you have significant influence or not? Own less than 20? Presume no significant influence. Trading security, market to market value, realized and unrealized gains and losses, go through the income statement. But if you own common stock between 20 and 50, the presumption is what? Oh yeah, significant influence, equity method of accounting. That's the common equity. The preferred stock you bought, you treat separately. When you have an investment in preferred equity, no voting rights, you can't have significant influence. You exclude that. The preferred stock under US GAAP, preferred equity, fair value through P&L, treated as a trading security. Market to market value, dividends or income, all gains and losses, realized or unrealized, flow through the income statement. Okay, so the significant influence test is only going to be satisfied with respect to the common stock percentage you own, because that's generally the only stock that's voting, okay? So the common stock's going to dictate whether or not we have significant influence or not, alrighty? Now, when we look at dividends, any dividends on the preferred stock, well, unlike common stock dividends, dividends on preferred stock, that's income. Because for the preferred equity investment, you got to treat that as a trading security, market to market, and the dividends are income. Now, if you own both, common stock and preferred stock, your percentage share of the profit is going to increase your carrying value, and it's also going to be your share of their net income. But be careful. You take your net income, you have to subtract from that the preferred dividends to get the income available to common stockholders, okay? So in the other example we had the net income of $90,000, and then we took 40% of that. Let's pretend the net income was $100,000, but let's say the preferred stock dividends were $10,000. All right, so you take the 100 minus the 10, the income available to common stockholders, $90,000, 40% of that belongs to us. That's our equity earnings. That makes our carrying value and our investment go up, and that's our equity earnings, $36,000, okay? So when there's treasury stock, that reduces the income available to the common stockholders. It's also your numerator, by the way, when you do earnings per share. And then when you get dividends, separate the dividends on the preferred from the dividends on the common. And the dividends on the common, remember, if it's a common stock dividend, if they're only giving you more shares of stock, memorandum entry only. Okay, not enough yet to do any questions. Come on back. Couple more and then we'll bang out some questions. Hang with me. Let's go.